$70 billion in just 341 days. Some predicted it would take years for any single investment vehicle to accumulate that staggering level of assets under management. Yet here we are, witnessing a financial phenomenon that has taken Wall Street by storm. That phenomenon is BlackRock's iShares Bitcoin Trust. For many onlookers, the scale and speed of this fund's growth feels almost impossible to comprehend. But what is really driving this rocket ship? And how did it captivate both everyday individuals and the most entrenched institutional audiences in such a short span of time? Today we are going to peel back the layers on one of the fastest-growing exchange-traded funds in the marketplace, an ETF that has turned even the most reluctant financial advisors into enthusiastic advocates of digital currency. We will explore why investment behemoth BlackRock placed such a large bet on Bitcoin, how regulatory shifts and brand recognition cleared the path for seismic levels of capital inflow, and whether this marks the beginning of a permanent realignment of crypto in traditional portfolios. Get ready for an in-depth journey into the reasons behind iShares Bitcoin Trust's meteoric rise, the challenges it overcame, and the questions it leaves trailing in its wake. In this episode, we will untangle the reasons behind BlackRock's surprising pivot toward crypto. We will examine the psyche of institutional investors who ordinarily avoid high-octane assets and try to figure out why these same players are charging into Bitcoin with unprecedented zeal. We will decode the significance of the brand factor, how the mere name BlackRock eases the anxieties of boards, compliance committees, and cautious advisors everywhere. And we will introduce the data-driven insights of Bloomberg Intelligence experts, who reveal the extraordinary increase in holdings by advisors filing what is known as the 13F form with the Securities and Exchange Commission. Lastly, we will consider the role of the broader geopolitical and economic environment, including deregulation under the Trump administration, which has arguably paved a more hospitable road for Bitcoin and other digital assets. First, let us wind back the clock just a little. When iShares Bitcoin Trust, often referred to as IBIT, was launched, it courted the same skepticism that attends most crypto-related products. Detractors claim that large institutions, especially buttoned-up wealth management firms and pension funds, were too traditional to embrace something as volatile and complex as digital assets. And for a fleeting moment, it did look like IBIT might struggle. There was a slight dip in net inflows at the end of May and the start of June, fueling talk that the hype was fading and that the fund's early success might have been nothing but post-pandemic mania. However, around 1 week later, IBIT soared back stronger than ever. In an astonishing rebound, the fund netted approximately $1.1 billion of inflows in a single week, pushing its total assets well above $70 billion. To put that in perspective, the entire exchange-traded fund sector is over 3 decades old, yet no previous fund had ever reached that lofty sum in such a short lifespan. One might think only hardened crypto believers were piling in, but the data suggests otherwise. The ranks of new investors include some of the most conservative segments of the financial world: wealth management offices, pension funds, and institutional advisors, so-called big fish, in the words of Bloomberg senior ETF analyst Eric Balchunas. Before we dive deeper, let us linger on an eye-popping statement from Balchunas himself. These are bigger fish that do not bite quickly. Indeed, it can take years for institutions to warm up to a new financial product, especially one with the volatility of Bitcoin. But sometimes conditions shift rapidly, and when a respected asset manager like BlackRock plants its flag, institutions follow suit at a stunning pace. Balchunas noted that in the year 2025, around 1,200 filers of the 13F form, those with more than $100 million in qualifying assets, were holding IBIT shares in one way or another. To him, that was insane, a sign of both a changing appetite for risk and a new recognition that crypto might be here to stay. Why is this happening? We can point to various catalysts. One is the brand name BlackRock. This is the reigning titan of global asset management, a Goliath overseeing more than $11 trillion in assets overall. If you are a cautious board member or an anxious member of a compliance team, you might think, if there is one name that will not spontaneously vanish in the night, that name is BlackRock. For many professional investors, BlackRock's presence in the space is all the reassurance they need. It is a path of least resistance, in the words of Rick Edelman, founder of the Digital Assets Council of Financial Professionals, When your firm decides it wants a taste of Bitcoin, going with the biggest and perhaps most universally recognized asset manager is an obvious choice to insulate the move from skepticism. However, brand recognition alone cannot explain the entire phenomenon. There is a broader wave of acceptance, driven in part by a more relaxed regulatory stance during the Trump administration. The connection is not complicated. When regulations loosen, more products are approved, mainstream brokers are more likely to offer them, and advisors no longer fear the same compliance nightmares. Meanwhile, advisors are fielding a rising number of questions from clients who say, "Why am I not in crypto yet?" Or, "Should I be worried I am missing out on Bitcoin's next boom?" The sense that this asset class is the new frontier or the next big wave has become contagious. People see Bitcoin's value continuing to outpace most traditional indexes. Bitcoin was recently trading around $105,000, a year-to-date gain that dwarfed equity benchmarks, and they wonder if there is any end in sight. Incidentally, that climate of rising interest coincided with an invigorated push from wealth advisors to learn more about crypto. Rick Edelman has commented that you cannot offer guidance on something you know nothing about. So, the impetus was on financial professionals to allocate time and resources, reading white papers, taking courses, and immersing themselves in the somewhat alien realm of digital currency. Whether it is the novel concept of cryptographic keys, the intricacies of wallet custody, or the wild daily price swings, crypto demands a new literacy. Edelman points out that many of his advisor colleagues are warming to these complexities faster than ever. One reason is that they see real client demand, and they realize they would lose out if they did not stay ahead of the curve. After all, if a client asks for a slice of Bitcoin and you cannot provide it, they might move that slice of their business to another advisor who will. Interestingly, the explosion of IBIT can be read as a direct reflection of this new appetite. Once a crypto ETF is out there, especially one from a household name, the barrier to entry for mainstream institutions shrinks substantially. Newcomers can access spot Bitcoin exposure without fretting over how to store private keys, how to navigate specialized crypto exchanges, or how to handle the security pitfalls that plague novice investors. Instead, it is all neatly packaged in an ETF, a structure they already understand. The liquidity is there, the regulatory framework for ETFs is there, and so the entire process feels safer, friendlier, and more normal. But let us not ignore the numbers. As Bloomberg Intelligence found, investment advisors filing 13F reports represent roughly 1/5 of the total holdings in these spot Bitcoin ETFs, a not insignificant chunk of about $21 billion in Bitcoin exposure. Balchunas believes that within the next year or so, especially as more wirehouses and large-scale wealth management platforms come on board, that advisor stake might swell to 35 or 40% of overall assets in these funds. If that expansion takes place, it could mean tens of billions more streaming into IBIT and its rivals. Speaking of rivals, why is iShares Bitcoin Trust so much bigger than the competition in the spot Bitcoin ETF arena? According to Edelman, it all comes down to that brand supremacy. He says it is the easiest decision for any board or group of executives confronted with the question, where do we place a portion of our digital assets? Instead of negotiating complicated approvals for lesser-known issuers, or explaining to upper management why you are entrusting millions of dollars to a new player, you can point to BlackRock's track record, scale, and global reputation. That does not guarantee that the underlying Bitcoin market is any less volatile, but it does reduce the friction of worry from stakeholders. We also should note what happened to the price of Bitcoin itself, and how that might have catalyzed the rush among advisors and institutions. The coin soared toward $105,000 in this new climate, building on momentum that had been simmering for several months. The Trump administration's friendlier stance, at least in some corners, helped quell certain regulatory fears, and more crypto-friendly policies all seem to encourage bigger players to test the waters. Of course, some advisors might still consider digital assets too risky, but the tide is shifting. Even old-school thinkers cannot ignore a run-up that dwarfs returns on many stocks and bonds, especially amid a sputtering global economic landscape. Now, let us zero in on Rick Edelman's stance. Since he is one of the more outspoken leaders in the advisor community, he has gone so far as to say that advisors should allocate a minimum of 10% in digital assets for conservative portfolios and up to 40% for more aggressive clients. That is a sea change from the days when the typical recommendation for crypto allocation was in the low single digits. 20 or even 10% might make some wealth managers cringe. But Edelman believes that the old paradigm, where you neatly split everything into a 60-40 ratio of stocks and bonds, no longer cuts it. In a world where crypto has proven itself capable of spectacular gains and equally spectacular volatility, ignoring it entirely could leave clients out of one of the century's most disruptive financial innovations. If you are finding this discussion enlightening, feel free to share a friendly thumbs up or a like. It not only helps spread the word about these insights, but also encourages more analysis on whether this surge in crypto ETFs will shape how investors and advisors approach personal finance in the years to come. While the appetite for crypto becomes more mainstream, Sumit Roy, a senior analyst at ETF.com, weighs in on the deeper motivations of advisors and institutions. Many are drawn to the idea of gaining exposure to the digital asset class without dealing with direct custody of private keys or the risk of hacks and operational glitches. The regulated ETF structure delivers a sense of familiarity and reliability. Institutions can hold shares just like they do for any other ETF, rather than messing around with cryptographic keys or trusting lesser-known platforms that might experience downtime or security breaches. The shift in sentiment also reflects how quickly the knowledge gap is closing. Only a few years ago, you had wealth managers who did not know the first thing about blockchain. Some thought Bitcoin was worthless. Others believed it was a fad for day traders alone. But as more big names step in, from Elon Musk to entire governments exploring their own digital currencies, the conversation has matured. We have moved away from "is crypto a scam?" to "how large a portion of my portfolio should I allocate to crypto?" That is a fundamental pivot in perspective, and it is being mirrored in how official institutions approach the matter. Indeed, the phenomenon extends beyond just the United States. Globally, regulators are taking stances on crypto of various strictness levels. Whether or not they explicitly encourage or discourage digital assets, the unstoppable momentum toward a more blockchain-centric future has become evident. The Trump administration's approach, which included steps to loosen certain regulations and provide more leeway for crypto innovation, acted as a green light for big players to take the plunge. Even if caution remains, the deep pockets of institutions are learning that ignoring crypto might be more perilous than embracing it in measured fashion. But let us return to the star of our story, iShares Bitcoin Trust, for a closer look at the dynamic that makes it so appealing to advisors, namely liquidity and brand synergy. Not only does BlackRock provide an enormous global distribution network, making it easy to slot IBIT into the same accounts already used for other iShares ETFs, it also leverages the trust of financial professionals. The result is that if an advisor receives a phone call from a client inquiring about the best way to add Bitcoin exposure, there is a ready-made product that fits within existing compliance frameworks, uses standardized reporting methods, and can be recommended without accusations of reckless speculation. The remarkable part is that IBIT soared from basically $0 to $70 billion, while skipping much of the messy friction that has plagued smaller crypto startups looking to secure institutional capital. Eric Balchunas' commentary hints that what we are seeing now could be just the tip of the iceberg. If today's 1,200 or so 13F filers holding IBIT shares double in number, which many analysts believe is possible, that would magnify the weight of institutional inflows to staggering new heights. For perspective, imagine if these large holders built up to 35 or 40% of total spot Bitcoin ETF shares. That would mean an even mightier avalanche of assets flowing in, inevitably pushing this trust and possibly the Bitcoin market itself to new extremes of valuation. Of course, raw price alone is not everything, but it does reflect investor enthusiasm and underscores the mainstreaming of a once controversial technology. In the midst of this exponential growth, we find an intriguing detail. Real people are behind these statistics, from the smallest independent advisor in a suburban office to the major chief financial officer of a multinational corporation. When they decide to allocate capital to crypto, it is not a trivial leap. They must answer the question, will this still be a stable decision tomorrow? That is where the presence of a titan like BlackRock eliminates a multitude of concerns. In that sense, IBIT represents a fusion of tradition and innovation, a big, well-known name taking on the rebellious child called Bitcoin. The success of that partnership signals a profound cultural shift in how we perceive financial instruments. It has also fueled a dynamic conversation around how to classify crypto in the classic 60-40 portfolio model, where 60% is in equities and 40% is in bonds. Rick Edelman's approach is more radical than the standard. He effectively slices into that formula, introducing a chunk reserved for digital assets. While the precise ratio might vary depending on one's risk tolerance, he recommends 10% for the more reserved and up to 40% for the adventurous. He has made it clear that ignoring crypto entirely would be akin to disregarding technology stocks in 2001. That does not guarantee that the path forward for Bitcoin is smooth. Far from it. Volatility still stands as a major deterrent, but for those with the stomach and a long-term horizon, those concerns increasingly give way to excitement. You might be thinking, is this unstoppable growth likely to continue? Could the next wave of institutional players and advisors hop on board? Or are we on the cusp of another dramatic crypto correction? That is the tantalizing question swirling around all corners of the financial world. Some argue that as more funds like IBIT appear and as more wealth managers add them to client portfolios, that demand will keep climbing, sustaining the price of Bitcoin. Others point to cyclical downturns in crypto's past, warning that no bull market lasts indefinitely. Yet the underlying story of a broadening market might remain intact even if short-term fluctuations cause some jitters. Interestingly, it is not merely professional advisors who watch the charts with curiosity. Retail investors, too, see the headlines about billions of dollars flowing into an ETF. They see names like BlackRock, and they suspect that maybe the big fish know something they do not. If the avalanche of money is to be believed, one might guess these large institutions foresee further upside for Bitcoin. That, in turn, can create a self-fulfilling prophecy, where optimism begets optimism. Still, one cannot ignore the cybersecurity angle or the potential regulatory curveballs that might come from future administrations, whether that is a new president or shifting majorities in Congress. At the same time, the principle of diversification remains at the heart of portfolio construction. Many advisors who were once hostile to the idea of digital assets are now adding language to their disclaimers, such as, up to a certain percent of this portfolio may be allocated to cryptocurrencies for the purpose of diversification. That alone is indicative of how normal these instruments have become. They have grown from the realm of contrarian day traders into an accepted slice of the investment pie. As renowned as BlackRock is, it is not the sole giant in this realm. Other players, seeing the success of IBIT, are likely to roll out their own products, fueling competition, innovation, and hopefully more favorable fees and liquidity conditions. If you find the prospect of future crypto expansions exhilarating, now might be a perfect time to hit that subscribe button so you can stay updated on all the twists and turns that are bound to come. Who knows what bold new Bitcoin-based instruments might emerge, or how many trillions of dollars might one day funnel into this once radical asset class. To keep perspective, however, we should remember that tremendous inflows do not protect an asset's price from volatility. Over the years, Bitcoin has seen its share of breathtaking corrections, sometimes losing half of its value in just a few days. ETFs can cushion some procedural aspects of investing, making it easier for big institutions to jump on board, but they cannot eliminate the fundamental swings in supply and demand that define the crypto market. What they can do is reduce friction, opening the door for more capital to enter quickly. Balchunas describes it as a phenomenon that can unfold rapidly once certain triggers are met. And it looks like we are living through that catalytic moment right now. Sumit Roy from ETF.com echoes the notion that we have only begun to see professional interest in these funds. He points out that, for years, more adventurous investors have been able to use direct exchanges and platforms like Coinbase to purchase crypto. But the large, methodical world of advisory services is more conservative. They typically wait for safer structures, like regulated ETFs, that align with existing operational procedures. Now that multiple such products exist, the gates have swung open, allowing even the most conventional managers to tiptoe into crypto, or in some cases dive head first. In the final analysis, iShares Bitcoin Trust has become emblematic of the generational shift toward acknowledging crypto as a legitimate component of modern investing. The synergy of brand recognition, friendly regulators, and skyrocketing demand has cast IBIT as the perfect entry point for those who once viewed digital currencies with skepticism. While the name Bitcoin might still conjure images of roller coaster price swings and uncertain fundamentals, the presence of a major asset manager behind it signals a sea change in acceptance. Are we witnessing the dawn of a new standard for portfolio construction, one in which the question is not, should crypto be included, but rather, how much crypto should we include? According to Rick Edelman, it appears that day may already be here. Advising up to 40% in Bitcoin and other digital plays is definitely not for the faint of heart, but it indicates that some advisors believe the technology's potential far outweighs the short-term roller coaster. No matter how you look at it, one point stands clear. The meteoric rise of BlackRock's iShares Bitcoin Trust underscores that the old dividing line between traditional finance and digital asset enthusiasts is rapidly fading. Advisors are moving in, institutional whales are buying, and new frameworks are being put in place to let them do so comfortably. The story is not just about big money chasing big gains. It is also about an evolving financial landscape, embracing innovation that was once dismissed as fringe. The revolution, as they say, will not be televised. It might just be tokenized, traded, and rolled into the next blockbuster ETF. For savvy observers, this is the best indication yet that crypto has grown up. The question left is whether you have a place in this new wave, whether you favor a cautious approach or you think 40% is not even enough. The conversation about digital assets can no longer be ignored. One thing is certain. If a slow-moving colossus like institutional finance can warm so quickly to digital assets, the ripple effects across global markets could be enormous, rewriting the rules of capital allocation for decades to come. The ride promises to be as thrilling as it is transformative. So hold on tight.